Ladies and gentlemen, welcome back to another podcast. As you guys have seen, we've already done two podcasts of two students of mine. Joshua, who's made $800,000 in profit and payouts this year. Then we have Arsh, who's already made $600,000 in the year as well. Two incredible traders from the Day Trading Institution, which we're now the Diamond Trading Institution. Now I brought on probably one of my younger students who's been in the community for a while, Chris. I'll let him introduce himself, or as known in the Discord as Good Boy Trades. So
that's crazy word. That's crazy word.
Anyways, so it's a little bit of an interesting story before we actually kind of get started here. I'll kind of let you actually start, but then we got to lead up to the point where we were at the HQ, which I feel like was a very pivotal point for you. But you actually just recently had one of your biggest months of, what was it, $25,000 or $30,000?
Yeah, like almost 30K.
Almost 30K, which is incredible because that used to be half of your yearly salary.
Yeah, a little bit more than half, and it was crazy to me. It was crazy to me that in a month, like, I could have just made that just trading.
And you did that all from your bedroom instead of actually going and working for somebody else.
Yeah, and that was the whole point of what you were starting with the story. Like, I was working a 9 to 5, you know, in and out of trading. Like, I've been trading for 5 years, but in all reality, I've been trading for a year and a half, where I've really just dove in and really just put it first over everything. And when I had that 9 to 5, it really was just back and forth of like, I'm there, but I'm not there. I'm not fully giving it my all. And then I ended up getting fired like 2 years into that job. And, you know, I didn't know what I was going to do. And I gave myself a cushion. Obviously, with that job, I had a cushion that I could give myself for like 3-6 months. And 3 months went by. I didn't really see much from trading after I got fired. And that's when we led up to the HQ, and I can kind of let you take it from there.
So basically, right, we have a mutual friend, and we were at the warehouse and we were talking, and Chris had came up to the both of us to have a conversation as to what he should do, if he should go back to his 9 to 5 job or potentially find another job or go all in on his trading. And I told him, it's like, look, bro, like, this is a sign for you. And I'm not even speaking to you like as your trading mentor, but also as a friend as well. This is going to be a very pivotal moment in your life where it's either, you know, you go back to 9 to 5 job and you keep living the same exact way, or you put your back against the wall now and actually make it happen trading. Now, granted, you know, he's already been in the space for a few years at this point. He's already been learning from me from a few years at this point. He just needed very small shifts to be able to actually start making money and leveraging prop firms the right way.
It's honestly been, bro, a journey, especially with order flow. Just going to dive into order flow was probably the best thing I could have done, because that gave me such insights into the price action that I didn't see before. And it's funny because before, when I was trading price action, I was just like, okay, cool, like I'll wait for a 5-minute engulfing, but my risk reward would end up being a 2-to-1 on a 20-30 point move. When now we're catching 20-30 point moves and our risk reward's like a 10R, 13R. And it's like, where was like order flow before then? And it's like,
yeah, I know, right?
How the hell am I gonna trade now without order flow? I can't do it.
I know, and that's exactly what I've been telling you guys, like, across all of my YouTube videos. Like, so many people have told me, like, Raul, why did you change your strategy? It's like, I didn't change my strategy. I made a pivotal shift inside of my trading system and my playbook that allows me to execute on my edge before the edge was even present, just from price action confirmations. So essentially, is I'm confirming my trade before we had the original price action confirmation by looking at the orders coming in and out of the order book and identifying the edge before price even gives the actual signal. Because when you're trading price action alone, what you don't understand is you're trading delayed data. And once I stumbled across order flow, that's when really everything kind of like also shifted as well, because now I'm actually trading the data in real time. So although my playbooks look the same, and there's differences now because it's really all order flow. It's really an entire order flow playbook, but in terms of market structure, trends, moving averages, all of that stays exactly the same, and the way I view the markets stays exactly the same as well. The only difference nowadays is I don't build a bias every single day anymore, and I'm not opposed to taking longer shorts on that one day. I'm just literally looking at the data around my key levels of interest that are based off of market structure, price action, volume profile now integrated, because again, you have a deeper understanding as to where real liquidity is being generated inside of the markets and where the market participants are actually finding value. And like, you get an extra edge. It's kind of like if you knew, maybe I'll give you an example. You knew about 90% of what the market does. Now you know 95% about the market instead. And that gives you better trading decisions, allowing you to be essentially more profitable. And then on top of that, like Chris said too, it's like there would be trades we would take in the past that, waiting for a price action confirmation candle, we would end up only getting 2R. And I've shown multiple examples of this before. And that would be like a 40-point move. Now a 40-point move on 3-4 points worth of risk is 8, 9, 10, 11, 12R for us, and we're able to catch, like, on a solid winning day, an easy 5 or 6R. Like, that's average on a solid winning day. But before, to get a 5 or 6R, you're talking about like my average trade, even just going all the way back to the FTMO days, for a 2R multiple, that was an average of like a 2.5 hour hold. And again, it was like a 30 pip risk, because I was commodities at the time, or metals. It was like a 30 pip risk for like a 30 or 60 pip gain. It's like you just find different ways to improve your edge over time. So getting into order flow is not something where you're changing your entire strategy. What you're doing is you're adding this data to your strategy to give you a lot better entries, which in turn will give you better R multiples, and of course increase your win rate, because you're not getting faked out of the market all the time.
I mean, bro, like the footprints and volume profile is just like the tip of the iceberg in order flow.
Yeah.
Once you start going into like the heat map and like the DOM and things like that, that's when you really start seeing a lot more of like your not strategy changing, but how you view the market, and you start seeing that not just support and resistance will be what counter, like what brings a catalyst into the market, pretty much.
Because the thing is, I think now with getting to order flow, when I look at like technical key levels, like although in the past it's like, yeah, we had some crazy reactions off of these technical key levels before, when I look at them now, it's kind of like I'm not really seeing much at this key level. There wasn't much liquidity generated earlier here today, so it's not like an area of interest for me. Like when I look at a technical key level now, it's like, okay, well, let's call it at 6,500. It's going to be a resistance range. It's going to be around psychological number where we know market participants like to enter the trades. So okay, well, if price is pushing up to 6,500, I'm not going to be looking at exactly 6,500, because I see offers sitting at 6,510. So I'd rather wait for price to push up into those offers. Those resting sell limit orders is what I refer to as offers on the book, and I'd rather wait for those orders to get filled and then see if those offers reload on the order book for me to execute. But that is a 10-point difference between 6,500 and 6,510, where by the time price comes back and reclaims beneath 6,500, I could already be 5-6 points in profit.
I mean, you're looking at the offers, and it's like, if you're looking at it in probabilities wise, it's like what's the probability of price going to hit this offer or this bid for vice versa? Compared to like a technical level where you're looking at a technical key level, like, oh, we should get a reaction off this level, and then price pumps up maybe 3-4 points on top of that, but ends up doing the, let's say, going short if we're talking about offers here.
Yeah,
you get me?
Yeah, that's my favorite playbook setup, because I was actually back testing most of the trades that I took this year that are basically going to be absorption reversals. Wow, I can't speak today. Wow. Absorption reversals. That was bad. No, that was bad. Absorption reversals, and I found that like you have like an A setup where the absorption is there and you see the orders reloading on the book and you take the trade there. That's like an A setup. But an A plus setup is when you have, let's say, prices coming down to an area of liquidity where you have a lot of bids sitting. You actually see these bids get filled into the markets, and I need to see a few hundred bids get filled into the markets simultaneously. And then what I like to see is like a sweep of that original absorption and then a reclaim of that absorption. And once we reclaim above that, where that original absorption was, I'll take the trade right then and there, because it's like literally an A plus setup, because you have the sweep, you have the trapped sellers in the situation where you're looking to buy. It's literally the A plus setup, although you can still be wrong.
Yeah, of course, it's all probabilities, because it goes back into like the heat map. It's like, if we're at a technical key level, like you said, 6,500, and we have the 6,510s, and it's like there's over 600 orders at the 6,510s. Why am I going to take that trade, wait for price to come up to the 6,510s, just call it a day after that?
Yeah, and the thing about it too is like you have to kind of get into a little bit of a different mindset. I think I told you this about your trade earlier today, because your stops are just naturally so much smaller. Your very first entry might not be right, but even if you do take a loss, it's only like a 2, 3, sometimes a 4-point loss, which in reality, it's super small and it's super tight, and that's why we're able to get such large R multiples. So you have to be willing that if your trade is still valid, to give that trade another opportunity to run if that position is still valid, of course. So it's a little bit of a different mindset. Your trade frequency is most likely going to increase, but then again, so is your win rate and so is your R multiple. So, you know, you just really have to build into that type of skin compared to like one entry. If you get stopped out, then the trade is most likely wrong anyways. It's like, it's not really the case when it comes to order flow, because you're looking for these different points of data at these areas of interest. So what would you say like your top 2 order flow softwares to look at are?
Probably Sierra charts, and at this point I've scrapped ATAS. I've just used the heat map. I honestly look at my volume profile key levels on Sierra, because you can just integrate it. So it makes a lot more sense to use just Sierra and the heat map, seeing where the orders are, having the DOM on Sierra as well on top of that, as well as seeing the footprint charts in that moment, and then seeing the book map as well. So those 2 pretty much help me a lot.
So the footprints and the book map is mainly what you look at. Yeah, I would probably say the same. Honestly, I find myself being a little bit more attentive towards the heat map and the DOM that's on the heat map compared to the footprints. As to before, I'd really be looking at the footprints, except for like when you actually see price get into these specific levels, like each cluster will have its own point of control because there's volume traded at each cluster, and that volume is distributed differently. Like I like to pay attention to like those high volume nodes within inside of just the cluster, not like an overall volume profile. But then from there, it's kind of like I'm really more watching the heat map for that absorption, looking for that reversal. Like my playbook used to be break of the highs, break of the lows, bounce plays, and breaks and retests. So 4 setups overall. Now it's only 2. It's absorption reversals and low volume node continuations. That's literally it. And even when I did like the 5K to 20K challenge, like 90% of the trades were absorption reversals.
Yeah, and I saw that like with the mean reversions, if we want to call it, or the absorption reversals, those trades mostly play out based on the volume that comes in from, let's say, the open. For example, you'll see price pretty much have a huge 20-point dump, but you're catching the reversal, seeing the absorption on the heat map, and then seeing the interaction between the buyers and the sellers of the bid-ask on the footprints. That's what causes to take the trade. Some people just trade price action, see a 20-point dump, think the market's going short, and then miss out on the move because they don't have that information. And it's like we preach in the live room all the time. It's like, if you don't have this information, how are you going to know this is going to happen? How are you going to know after that dump, price is going to pump back up?
Yeah, especially if you can't see like large buyers starting to actually fill the market. Like there's so many like different hidden messages, because if you see like a really sharp and aggressive dump, but on that sharp and aggressive dump, large buying is actually getting filled on the way down, followed up by aggressive buying, there's a lot higher of a probability that price is going to reverse and continue. But by looking at a candlestick chart, you only see like that one large dump. Most people will be like, all right, let's look for this to continue to go down. It's kind of like we're doing like the opposite now, which actually feels really good, because it's like I don't like doing
the lives, and they'll be like, why are you guys not looking for shorts after a 20-point dump, like shorts after a 20-point dump? And we're like, well, if you look at this in a bigger scale, you see that like on the day, like, because again, it goes back to what you were saying. It's like, bro, yes, the strategy hasn't changed. It's still the same thing when I used to trade Forex when I first joined DTI. It's like support and resistance, 4-hour key levels, 1-hour key levels, and all we're doing is getting better entries. That's all it is. It's to put it in the simplest terms, and I feel people confuse it a lot. Like, oh my God, it's so complicated. It's not that complicated.
It's really not that complicated. Like, bro, it's like literally like when you were first getting into trading, it's like you start learning all these different things. Like, oh my God, this is so complicated. But then after like 2-3 months, you're like, okay, I actually kind of understand this. And then it comes time to actually experience it and apply it in real markets. But then again, it's like I remember that live, because the last live that I did, because I wasn't able to hop on live these last 2 days, was we were taking longs after a huge sell-off in the markets. Most people are gonna assume and look for a continuation. I remember, I think his name was Samuel. I was like, Raul, why are you longing the market right now when the market just had a huge dump and overall in the higher time frame trend we're bearish and this and that? And it's like, bro, if you look at the order flow data, remember what you're looking at is you're looking at what already happened. What already happened doesn't signify that you're gonna make money, but I can see what's happening right now. And what's happening right now is that at this specific level of structure and at this specific level of interest, sellers are struggling to push price lower. With sellers struggling to push price lower and buyers reloading on the bid and supporting the market at these areas, we're gonna most likely see a reversal. There's a greater probability that we're gonna see that reversal, and we did see that reversal. We ended up, I think that's the trade that actually that actually got me to $20,000, and then we ended up making like 5R on that trade.
Yeah, it was like a 5R trade, and I think because it's funny, if you look at like if you look at the track record of our live room, I think most of our biggest trades are all mean reversions.
Yeah, I mean, whether it's a mean reversion or whether it's a reversal in technically a continuation of the trend, again, it goes back to it's an absorption reversal, you know. So like that's the thing about it is like I like low volume node continuations, although it's not really like a setup that I like to put a lot of size.
Yeah, I try to be very low risk on those because I've noticed that you need to see the volume hit the tape or the DOM, whatever you look at, right away and see the aggressive market orders come in your
at that low volume node, and then look for that continuation. Like if price pushes into that low volume node and it kind of starts to like dance around there, we see a lot of transacting going on. That's kind of where the trade gets sketchy. And the longer that price hangs around inside of that low volume node, which for those of you guys that don't know what a low volume node is and you're watching this podcast right now, what a low volume node is, it's simply an imbalance in the market caused by a lot of aggressive buying or a lot of aggressive selling, leaving not much room there for previous market participants who have transacted. And really, you're going to be able to identify a volume or a low volume node, whether looking at a DOM or you're going to be looking at a volume profile. So you want to think about a low volume node as essentially like a fair value gap. But the thing about it is like, when you talk about ICT concepts, it's like you can't really confirm if it's an actual fair value gap or not because you don't know how much volume was transacted there prior. Because like you could have technically what would look like a fair value gap on a price action chart, but if you look at a session volume profile or even like a cash session volume profile, you could see that there was a ton of business conducted in that fair value gap. So there's no gap there in fair value. We're just pushing to the other side of that fair value. So when you actually use a volume profile, you're able to confirm, okay, well, this is a real fair value gap, in which when you look at it in real terms, it's a real low volume node. There wasn't much business conducted here, meaning that there wasn't a lot of buying and selling happening, and there wasn't a lot of market participation inside of this low volume node, and that's caused by buying or selling imbalances, which when you have a large buying or selling imbalance, which you can confirm again on footprint charts on a heat map, that's typically when you see a breakout happen inside of the markets. And when you look for pullbacks into this low volume node, where you need to see really quick for there to be like a really high low volume or high probability low volume node continuation setup, is you want to see market orders in the tape speed up really quick as price starts to get into that area and almost like an immediate rejection, and just for market to essentially go after that. Because I think there was a trade that I took on the live, maybe like on, I think it was Friday or Thursday, where I took a low volume node continuation setup, and I literally said it. I'm like, okay, well, price pumped up at first. I was slowly maybe like 2R, and then we came back into that low volume node. I'm like, guys, like the longer we hang out here, like this trade is going to start to deteriorate over time. So we need to see prices start pushing, and then price ended up coming down and hitting SL for like, I think like or like for like 2 points or like 3 points or
I think that trade, I think that trade we broke even. I don't think we took a loss on that. I think we retried it and then we took the loss. But yeah, without volume profile either, it's like, I understand that ICT concepts, I don't really listen to all that, but if you look at it in hindsight, it's like, how are you going to see something with just, it's like saying you look at a painting and we're seeing the painter paint the picture for us.
Yeah, basically.
Yeah. And it's like, how do you see that based on the final product without seeing the process?
Yeah, I mean, like the way I look at ICT concepts, really what it comes down to is they're non-confirmed order flow concepts is really what it comes down to. Because if you look at like the fair value gap and different things along those lines, like it's essentially what a low volume node is, except you don't have the real confirmation by looking at a DOM or a volume profile to confirm that, okay, this is actually the low volume node here.
Exactly, yeah.
In my opinion, that's what it is. It's just, I guess, regurgitated information. And it's not even that it's regurgitated, because you're not actually into order flow too. And like the thing about it too is like, there's so many traders too that I talk to that tell me, yo, yeah, like I trade order flow, and what they're talking about is literally like just market structure, like the flow of the market structure. And I'm like,
yeah, I've seen those memes. Nah, for real. It's like you're not trading order flow, and it's like
if you're not looking at a tape, you're not looking at the actual orders coming in, getting filled on the bid or the ask, you're not looking at order flow.
No,
which is fine. Like you don't theoretically need order flow.
There's price action traders that can trade price action, bro, and it's
but it's order flow is gonna give you that edge. And like you said at the beginning of this podcast, it's like once you get into order flow, like you're like you can't trade without it, and it's just, it gives you this deeper insight as to what the market participants are doing that you don't want to trade without it.
Bro, it's like we go on vacation and we're trading. How else? I can't trade without it. Like I need it in front of me to be able to take our moves. Like, it's not possible at this point. And it all stems from this again. And I feel like we repeated ourselves through
I feel like it's like crack.
Yeah, because you need to look at the market orders hit the fucking market. And
I'd rather, bro, honestly, like if I don't have access and I need to trade to my order flow tools, at least a heat map.
Bro,
you know what I mean? Like bare minimum. Like the most friendly and easy to understand order flow tool is a heat map. If I can't get access to at least a heat map, I'd rather just go to the casino, to be honest with you.
No.
That's how I feel now. But although I made a shit ton of money before just trading price action alone, but I see the difference in profitability now. I look at the data every single day from when I only traded price to using order flow with price action. But again, like one of my students actually told me this saying, it's like the way order flow is explained to him is that like price action and like key levels, support and resistance, supply and demand is like the batter to the cake, you know, and then order flow is like the icing on the cake. If one of them is shit, then the cake is just gonna be ass overall. You know, both of them have to be really good.
Yeah.
And then that's when you see like, wow, this is a great fucking cake. But then again, it's like it's just so many different things. So now you mainly trade prop firms. I haven't traded prop firms in a while. I will start trading prop firms again. So I mean, I traded, you know, some prop firms here and there throughout this year, made some good money on payouts, but you solely trade prop firms.
Yeah, I solely trade prop firms. I do want to get into a live account, but right now I'm solely with prop firms, mostly Top Step, just because their process is so easy. But besides that, I do want to go into a live account and potentially see what I can do. Like I think you had a live account for a little bit and you were able to grow it. I've had friends that grow those live accounts pretty easily, but I feel like there's a difference between you have rules and set in place already for you that you can't break, versus you have pretty much you can do whatever you want, go ham.
Yeah.
And it's like some people, I feel for me, and I've spoken about this with students. It's like I would prefer to have those rules in place just for my psychology, knowing that I have those parameters, than having an open range, if that makes sense to you.
Yeah.
So for me personally, like prop firms is the way to go, and I don't see it any other way.
So you only see yourself trading props?
Right now, yeah. For the next 6 months, yeah. I think starting next year will probably be when I go into the live accounts.
You can always start off small on a live account. You know, put in $2,000, $3,000 into a regular live account and one contract, you know, on the E-mini. So if you think about it, you trade mainly what, 50Ks?
Yeah, and if you think of exactly what you were saying, it's like max loss is 2 Gs. You're putting 2 Gs. They're giving you pretty much 2 Gs to trade.
Giving you 2 Gs to trade. The only difference is you have 5. But if you really wanted to, you can open up 5 live accounts, put 2 Gs in each, and just copy trade them if that helps your psychology. But then at the same time, like you could trade it exactly the same way as a prop account, especially when it's small, and look at it as, okay, well, this is a prop account, I only have 2 Gs to lose, although it's 100% of your balance. With the prop firms, it's the same thing, because how many contracts do you trade with normally with your 50K when you first start?
Like 1 or 2, maybe 2 if it's a A plus though. 2 if it's A plus, because at that point, because remember, I feel like, and I've noticed this when we're trading live together, my stops are usually smaller than yours.
Yeah.
And I'll tend to catch a 7R when you're catching a 5R.
Yeah, you normally do like a 2-point stop.
2-3 points depending on the position, but that to me is like, okay, if you think about it like this, in two contracts every point's $100. So if I'm risking 2 points, you're risking $200. If I'm risking $200 to make $1,600, that's an 8-to-1. You get me? So that's where I the tight stops and risking small to make bigger is where the psychology makes sense. And then when you're adding it on 5 accounts, it's fucking, you know, you're making 6-7K in a day.
Yeah, and you could do that on your live account. You just start off small, just 1-2 contracts. That's all you need, and you start building from there. And as the weeks progress, and you go from 1 contract to 2 contracts to 3 to 4 to 5, and then you start really growing and building that account. Because really, once like you get up into like 4 or 5 contracts, like you're probably making a couple $1,000s a day at that point out of 4 or 5 hour multiple. Like even if you're only trading on 1 account, like you could be making $1,500 a day per winning trade. Bro, I want to say
3-4 points, you're up $1,500 on 4 or 5 cons. On 4 or 5 cons, if on a 10-point move, you're making at least 3-4K.
Yeah, so yeah, and then like when you really start to see money is when you start getting into like 15 contracts, 20 contracts, 30
You
contracts.
showed me the other day you were in like a 10 contract position on a.
Yeah.
I was like, holy fuck.
And that's not even like I used to trade way more contracts before. Like maybe like 2 years ago, 3 years ago, I would be throwing 30, 40 contracts on the S&P 500 E mini futures.
Dude, that's crazy.
So yeah, but I mean, you know, it's, you know, different market conditions, different.
Yeah, of course.
You know, yeah, I remember there was this one trade. This is when I had my old Bugatti. We were in the office and I was trading, and I put 30 contracts on a short on ES. I look up for 2 seconds. I talk to one of my boys. I look back down. I'm floating $40,000-$50,000 in profit, and I actually made a full breakdown on that trade and posted on YouTube. It's actually on my main YouTube channel. You just have to scroll through my YouTube channel. You'll see like trade breakdown 40K or 50K trading futures, and then you'll see the profit on my TradeStation account that I had at the time. So then you've already had a huge month. What is like your game plan going forward?
Bro, if you want me to be honest, it's finding consistency. Because what I've noticed in the trading space is a lot of people will just have a good month or two, and then they'll go on a rally thinking they're the greatest, when really what you want to do, in my opinion, is build consistency with that for the next 6 months, 6 months. And from there, you can go ahead and say, okay, now I can scale into more. Now I can put more money. Like, for example, now I can go into 150K accounts instead of going into the 50Ks, putting more risk behind my trading. And it's gaining that confidence, because I've noticed as well, it's with trading, you're at a constant battle. No matter what point you're in, you're profitable, not profitable. When you're profitable, you're trying to get better every day. And if you're trying to get better every day, you're struggling to see the deficiencies, when in reality, they might not be as bad as you think from a hindsight point of view. But when you really dig deep, there's things that you could work on, and that's where I'm at this point. And that's where I want to take it, just grow from there.
I feel like most of the issues that people have as traders really just comes down to self-sabotage.
Yes, 100%.
That's literally most, at least from what I've seen, what I've experienced, most of the issues really just comes down to self-sabotage. Most people can't like control their own decisions. They can't control their own emotions based off of their previous trades. And it's like separating yourself from each and every trade and taking one trade just as, okay, it's just one trade out of hundreds of trades, but they're like, fuck, I just lost the last 3 trades. Let me actually go a little bit heavier so I can make back the losses of those 3 trades plus a little bit more. When in reality, it's like, that's not the case. It's like, if you really think that you're going to be here trading for the next 10, 15 years, what does the last 3 trades matter? Just trade as if you were trading normally and forget about those losses, and really just treat each trade as its own individual. That's really what it comes down to, in my opinion. If you guys enjoyed this podcast, there's going to be more to come. If you guys actually want to trade live with us every single day, you can click that very first link in the description, and we'll see you guys for the next podcast.